Back in 2023, my dad bought some Intel stock that went up 20% in just a few months. He was checking his portfolio every morning, like it's his ex's Instagram page. He was convinced that, hey, I figured something out. Then, tax season hit. He found out that he owed over $1,000, and just like that, his 20% return became a 10% return. Half his gains gone. Not because he picked the wrong stock, but because he didn't think about taxes. This is what nobody tells you. A great return on paper means nothing if you don't keep it. And right now, this is happening to millions of investors, probably including you. In this video, I'm going to break down 3 things. 1. How taxes are quietly cutting your rate of return in half. 2. How much it's actually costing you. We're talking about over $500,000 difference between someone who gets this right and someone who doesn't. And 3. The exact steps to fix it without a financial advisor or any complicated strategy. But before we get into all of that, I want to answer the question I know some of you are asking right now. How do I know this applies to me? If you invest anywhere outside of a tax advantage account, this is already affecting you. And if you just ask yourself, what the heck is a tax advantage account? You need this video the most. Let me ask you something. If I told you that you could invest your money, earn a 10% return, but only walk away with half that, would you call that a good investment? Probably not. But that's exactly what happens when you ignore taxes. Here's the math. Let's say you invest $10,000, it goes up 10% and you sell. How much do you keep? That depends. If you sold that investment within a year, the IRS considers that as ordinary income. And depending on your states, your combined federal and state income tax rate could be as high as 50%. So that $1,000 now becomes $500. And your real rate of return is 5%. It's like winning a hot dog eating contest. Your stomach is the size of a basketball, your dignity is still somewhere on the floor, and hot dog number 43 is still somewhere in your chest. And right as you reach for that trophy, a dude slides you a bill. Great job, champ. That'll be $400. What if I told you taxes, not bad stock picks or market crashes, could cost you more than $660,000 over your lifetime? Let's take 2 investors. Both start with $50,000. Both earn an average of 10% per year for 30 years. Investor A ignores taxes and does the opposite of everything I talk about here. He pays an average of 50% in taxes on his gains every year. On the other hand, investor B is tax efficient and does everything I talk about here, so he pays little to no taxes. After 30 years, investor A ends up with roughly $210,000. Not bad. But investor B ends up with over $870,000. Same starting amount, same returns, but investor B has over 4 times the ending amount, $660,000 more than investor A, just because of tax efficiency. As we've talked about, when you sell an investment you've held for less than a year, the IRS taxes that profit as ordinary income. Depending on your state, that rate can hit close to 50%. But if you sell that same investment after 1 year and a day, now the profit is a long-term capital gain, which is taxed at around 20%. The difference between a 20% long-term capital gains tax and a 50% ordinary income tax is not a minor accounting detail. That's the difference between retiring and actually retiring. One of you is traveling, sleeping in, and playing golf every day. The other is Googling, is 71 too old to go back to work? If you're getting value out of this video, make sure to hit subscribe for more. Here's where it gets really interesting, because everything I just showed you, that's just the difference between bad taxes and okay taxes. But what if you didn't have to pay the 20% either, like investor B? What if you could pay close to nothing? You put money in an account, it grows, you retire, you pull it out, and the IRS gets absolutely nothing. Every dollar you invested and all the growth belongs to you. All of it, no asterisk, no surprise bill at the end. That's what a Roth IRA and a Roth 401k can do for you. You put in after-tax dollars now, and in return, the government leaves you alone forever. A 10% return is a 10% return. If you're not maxing this out, that's the first thing you must fix. Now imagine a different account. Every dollar you put in lowers your tax bill today. So if you make $80,000 and you contribute $10,000, the IRS only taxes you on the $70,000 this year. The money grows untouched and you only pay taxes when you retire, ideally at a lower rate than you're paying now. For example, 20% instead of 30%. That's a traditional 401k account. Now, this last one is my personal favorite because almost nobody talks about it. Imagine an account where the money you put in lowers your tax bill now, and the money grows tax-free, and when you take it out for medical expenses like going to see a doctor or buying an air purifier for allergies, that's also tax-free. Tax-free going in, tax-free when it grows, and tax-free coming out. Triple tax advantage. That's what an HSA, a health savings account, does. Not everyone has access to this, but if you have a high deductible health plan and you're not using HSA as an investment account, you're leaving one of the best deals in personal finance completely on the table. In short, where you hold your investments matter as much as what you hold. Now, a regular brokerage account isn't a bad thing. It gives you flexibility that something like a Roth IRA does not. You can access your money whenever you want, no age restrictions and no penalties. The challenge is, how do you invest there without getting destroyed by taxes? Imagine someone who has full access to your investment account and trades in it every single day, buying and selling, racking up 50% tax bills on your behalf. You didn't ask for or know about most of these trades, but you're paying taxes on every single one. It's like getting a speeding ticket while you're sitting in the passenger seat. That's what happens when you invest in an actively managed fund. Now imagine the opposite. Imagine an account that just buys everything and holds it forever. No unnecessary trades, no surprise tax bills, just steady, boring, compounding growth. That's what happens when you invest in an index fund. Alright, now that you understand the problem and what's possible, what do you actually do? Step 1, open or max out a Roth IRA if you haven't. Step 2, max out your 401k or 403b. At the minimum, contribute enough to get your full employer match, which means for every dollar you put in, your employer will also put $1 in. That's an instant 100% return before the market does anything. Step 3, get an HSA if you can. Step 4, slow down in your taxable account. Every time you sell, you create a tax event. Trade less, hold longer. Step 5, ditch actively managed funds and go for low-cost index funds. They're cheaper, more tax efficient, and statistically, they outperform most active managers anyways. Now, here's something most people don't realize. Tax efficiency is just one leak in the boat. There's a bigger threat that can wipe all of it out instantly. Here's the danger. Most investors either have no emergency fund or build them wrong. So when life hits them, a job loss, a medical bill, a car falling apart, they're forced to sell investments at the worst possible time and undo years of progress instantly. So before you do anything else, watch this next video because all the tax efficiency in the world won't save you if life hits and you're not ready for it.